Hey everyone, welcome back to Corporate Decoder, the place where we turn corporate filings into something you might actually want to watch. Today, we're diving into a filing from Illinois Toolworks, but don't worry, it's not about making better wrenches, unless finance is the wrench you're trying to tighten. This report is all about debt and interest rates and how ITW is playing the money game. It's more exciting than it sounds. Let's start with the basics. This report is called an 8K, and it's basically a company shouting, hey, something important happened. The date to keep in mind is February 24, 2025. That's when the key event occurred, and it's all about money. So who is Illinois Toolworks, or ITW? They're a big manufacturing company, but they don't just make one thing. They make tons of different products, from car parts to restaurant equipment. They're like the diversified conglomerate of tools. Because they are a big and international company, they need to do financing. What's this all about? It's about an amendment to a credit agreement ITW has in Europe. Basically, ITW has a line of credit in euros, and they've made some changes to it. This is not unusual for big companies, but it is always useful to know the status of their debt. Now let's get into the meat of the report and agreement. ITW has this thing called the Euro Credit Agreement, and they decided to change it up a bit. Think of it like renegotiating your mortgage, but on a much larger scale. This agreement was originally made in May of 2023. This amendment or change to the agreement involves a few key things. First, it extends the life of the agreement. Second, it lowers the interest rate a bit. Third, it messes with the interest payment periods. Let's break down each of these changes. The first big change is that ITW has extended the termination date of this Euro credit agreement. It was supposed to end sooner, but now it goes all the way to February 2027. There's even a chance to push it out further to September 2027 if certain conditions are met. This extension is crucial because it gives ITW more time to manage its debts and finances in Europe. It's like getting a longer runway for a plane. The second key point is that the interest rate on this credit line is going down, not by a lot, but it is a good sign. The interest rate spread is decreasing from 0.75% to 0.70%. That 0.5% might not sound like much, but when you're talking about millions of euros, it can add up to real savings. This reduced rate means ITW will pay less in interest over the life of the loan, freeing up cash for other investments or operations. The final key change involves the interest periods, which means how often ITW has to pay interest. It sounds like they removed the option to pay interest every month. I guess that it simplifies things for ITW. Here's a big number. As of February 2025, ITW had 750 million euros outstanding on this credit agreement. That's a lot of money. The report also says they've fully drawn on the credit agreement. It means they are using the credit to its full potential. This could mean they have big projects or expenses they're covering with this credit. If you wanted to see the exact details, the actual amendment agreement is available as an exhibit to this report. It has all the legal language in fine print. Finally, the report is signed off by Randall J. Schuneman, who is the Vice President and Chief Accounting Officer at ITW. His signature basically says, yep, this is all true and correct to the best of my knowledge. Now let's step back and look at the bigger picture. What does this all mean for ITW? On one hand, ITW is a well-established company with a diverse range of products. It is not going anywhere. Extending their credit agreement gives them financial flexibility, and lowering the interest rate saves them money. That's all good news. On the other hand, ITW has a substantial amount of debt outstanding, and this is only in euros. 750 million euros is not a small amount of money. While the lower interest rate helps, it also is true that having this level of debt can create risk and create a problem if the economy has issues. They've fully drawn on their credit line. It means they are maximizing their debt capacity, which might be risky in the long term. Looking at the overall financial health of ITW, they seem to be managing their debt responsibly. The company is profitable, and the cost savings from the lower interest rate will help boost their bottom line. In conclusion, this 8K filing shows that ITW is actively managing its debt in Europe. The extension of the credit agreement and the lower interest rate are positive signs, but the high level of debt remains something to watch. As always, it's about balancing risk and reward. ITW seems to be walking that line carefully. Thanks for watching Corporate Decoder. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more insights into the world of corporate finance. Until next time,